Hello, everyone, and welcome to ROBO Global's Investor Call. My name is Jeremy Capron, and I'm the Director of Research, talking to you from New York City. With me on the call are Senior Research Analysts Nina Deca and Lisa Chai. Here's the agenda for today's call. We'll be reviewing our three technology innovation portfolios, Robo, HTech, and Think. And we will be taking your questions. So please feel free to type them into the Q&A box into the Zoom interface. And before that, I'd like to kick off with a brief summary of our company. ROBO Global is a research and investment advisory company that's focused on robotics, AI, and healthcare technologies. We are the creators of research-driven index portfolios that are designed to benefit from these megatrends. And 7 years ago, we put together a team of investment professionals and industry experts to design investment strategies around what we believe to be the next technological shift. Today, there's over $2.8 billion in funds tracking our strategies, primarily in ETFs. And the most notable is probably Robo, which was the first robotics automation AI ETF launched just around 7 years ago. We also run Think, the Artificial Intelligence Index, and HTech, the Healthcare Technology and Innovation Index. Our strategies are based on a research-driven approach with the benefits of index investing. The portfolios are selections of best-in-class companies from around the world, small, mid, large caps that are more or less equal weighted and rebalanced quarterly. These portfolios have very high active share relative to broad equity indices like the S&P 500 or global equity indices. And as you can see here, the three strategies have significantly outperformed global equities since inception. So we started with Robo, which covers the entire robotics and automation value chain. And the bubbles that you can see here represent the enabling technologies that make robots and autonomous systems possible, like sensing and computing. And then some key areas of application, such as factory automation, logistics, healthcare, consumer, et cetera. And in the past 2 years, we launched 2 additional index portfolios around 2 areas that really stand out in terms of their potential disruptive impact. Think, THNQ, and HTech, HTEC, are designed using a similar recipe to Robo in terms of the subsector approach and the research-driven selection of best-in-class companies. So let's talk about returns. In the third quarter, global equities continued their historic recovery from the lows of the COVID-19 shutdowns. We had a second consecutive quarter of large gains. You can see at the bottom here that the all-country world index was up a little over 8% in Q3. And the ROBO Global indices continued to outperform with double-digit returns for all 3 indices. And you can also see here the 3 research-driven strategies have largely outperformed year to date and over the past 1, 3, and 5 years. Note that the 3 and 5 years numbers for HTech and Think include a backtest for periods prior to inception, whereas for Robo, these are all actual returns. So let me make a few comments on the market and our outlook. First, the pandemic remains the key driver of market sentiment. And despite renewed second wave concerns, economic indicators continue to point to a much faster recovery than in prior global recessions, even with the large sectors like aerospace and leisure or tourism still in limbo. And the snapback recovery is supported by the extreme and I would say unprecedented fiscal and monetary policies introduced by governments and central banks around the world. These total more than 20% of global GDP. And unlike the 2009 situation, we're seeing real monetary growth across all key regions of the world, and that is primarily driven by government-guaranteed loans. And we have uncertainty around the timing of the next round of stimulus here in the US with the presidential election in just a few weeks. But we think policymakers around the world are very committed to continue to provide stimulus. And assuming that the threat from the virus continues to recede, we expect the cyclical recovery to gather steam over the next several quarters. We think our portfolios are very well positioned to continue to outperform in this environment. As businesses strive to discover new ways to operate safely and efficiently amid the pandemic, technology has become critical in supporting the new work environments that make this possible. And as a result, what we're seeing is that the digitization of the economy has been turbocharged in 2020. Our strategies are specifically focused on technology disruptors that are positioned to gain share as this digitization accelerates. Many of these have been massive beneficiaries of this shift, especially companies in the areas of AI, factory and logistics automation, enterprise software, and healthcare technologies. And next, I like to highlight that so far this year, the best performing stocks across our strategies have been found in the following areas: diagnostic, testing, and therapeutics, particularly as it relates to COVID-19 with companies like Moderna, Fulgent, and Quidel. Telemedicine and remote monitoring with companies like Teladoc, Ping An, Good Doctor in China, or iRhythm. And e-commerce and logistics automation with companies like Ocado in the UK, or Etsy, Shopify in the US, and JD.com in China. And genomics has been very, very strong so far this year. And here we highlight some top performers, Invitae and Natera. And finally, AI-powered platforms with stocks like Square, Twilio, Cloudflare, Wix, and Viva. The portfolios also offer very strong balance sheets, and I think it's important that we consider that in the event of, let's call it an ugly COVID outcome, which certainly is not our base case. But you can see here the ROBO portfolio has a 59% of its members that have a positive net cash position. That means cash exceeds debt. And that compares with just 15% for S&P 500 index members and 22% for the equity members. And similarly, HTech and Think also have a very high percentage of their members holding a net cash position. So they're positioned to weather the storm in, say, a cloudy sky scenario. So let's talk about ROBO. ROBO is a research-driven index of best-in-class robotics and automation companies from around the world. And as you can see on this chart, it has outperformed the World Equity Index over time, including in the past quarter when ROBO was up 11% in Q3 after a 29% increase in Q2 and a 30% gain last year. This quarter, we saw 9 of the 11 sectors recording gains. And the best performing sectors were logistics automation, that was up 17%, and healthcare, also just under 17%. Logistics automation is really important. That's about 11% of the index by weight, and we think it will benefit from the enormous strain that's currently put on e-commerce. Demand has significantly increased in the past few months, and we think a lot of this demand is here to stay. This is creating a step up in terms of adoption of e-commerce and the logistics automation that comes with it, automated warehouse solutions and the likes. So companies like Manhattan Associates, that's a leading provider of supply chain and warehouse management software and services, typically benefit. And other companies like Ocado, the UK online grocer, and provider of order fulfillment technology to Kroger here in the US. Or Daifuku, a Japanese company that's a global leader in material handling equipment. And there are other stocks like Zebra Technologies and the likes that fall into that sector. Elsewhere, we're seeing that adoption of AI-powered technologies remain the strongest driver of revenue growth for the Robo Index. You can see that at some of the fastest growing members like NVIDIA in GPUs. That's become a de facto standard for high performance computing and the training of AI in data centers. But other companies like Global Unichip, that's based in Taiwan, that makes semiconductor components and ASICs, or iFlyTech, another China-based company that's focused on natural language processing. And all these companies are likely to report more than 30% revenue growth in the third quarter. We've also seen some strong performance from automation software providers. So think about PTC, Autodesk, ServiceNow, Dassault over in Europe. They've continued to grow very strongly through the crisis. And the last point I'd like to make here is that Robo has a large exposure to the more traditional industrial automation areas. Those account for nearly 40% by weight. And right now we're seeing some very positive developments in the Chinese market for factory automation equipment that has returned to its pre-COVID growth trajectory. We've heard in the past couple of months that key component suppliers like Highwind, AirTac, Hans Laser, have reported some year-over-year growth after getting hit pretty bad in the first half of the year. So if we look at the top performers for Q3, Materialise was up 64%. That is a Belgium-based additive manufacturing company with leading positions in 3D printing software and also in medical applications. Materialise is really well positioned to benefit from 3D printing's increasing use in healthcare. And healthcare now represents over 30% of its sales. And then we think the stock also benefited from plans announced by Desktop Metal, which is a private metal 3D printing company that has raised over $400 million in recent years, and that now intends to go public in a SPAC deal. So we think that's brought more attention to Materialise in Q3. And Innovance, you probably haven't heard of this China-based provider of automation components. This is a domestic champion that has significantly increased its market share in the past 12 months. It's basically gaining share from foreign competitors in areas like servo motors or factory automation controllers. So the business is growing very fast, 80% year over year in the first half. So again, some interesting developments over in China. And Robo has a high exposure to China as measured by revenue. We think it stands around 15% of index revenue today. The other side of the spectrum, we're looking at the bottom performers in Q3, and 3D Systems was here. You can see that it was the weakest stock in Q3. Essentially, 3D Systems is suffering from its high exposure to automotive and aerospace industries, and the prototyping that's involved there. We think 3D printing is going to see some improvement starting from Q4. And AeroVironment, that's the global leader in small unmanned aerial systems for the defense industry. It's well positioned for high revenue growth in the long term. Most recently, they've won several UAV military contracts, and they have strong visibility for the rest of the year, but the stock has had such a large gain in Q2 that we think a pullback is simply normal. Finally, I want to make a few comments on the Robo portfolio as it currently stands. Here is a chart of the geographic diversification in the fund. You can see that international markets account for more than half of the portfolio by weight, with Japan and Germany and Taiwan with a relatively high representation here, and that's where a lot of the factory automation is happening. Diversification also in terms of the market cap, with small and mid caps accounting for 57% of the index, and that's important in the current context, because typically in recoveries post-recession, what we see is that small and mid cap outperform, and we've seen that in Q2 and Q3. But overall, small and mid caps are still behind large caps so far this year. And the last point I'll make is on valuations. I think there's an increased focus around valuations, and right now, ROBO is trading on a trailing PE of 32 times, and that is a 30% premium to the long-term average. However, it's important to understand that EPS, the earnings, are currently 25% below the high, and trending down so far this year. We think earnings are going to be down by about 15% in 2020, but they have bottomed, and that's really what we learned from the most recent earnings season. We saw the bottom in Q2. Earnings are set to continue to improve sequentially. And so going into next year, we could see very close to 30% EPS growth in 2021. And that means that that headline PE of 32 times actually is not too much of a concern in our view. And it's still below the historical high for the index that was reached in 2018, that was more than 36 times. So I will leave it there, and I'd like to pass it on to Nina to talk about HTech.
Thanks, Jeremy. Just a quick recap for those of you who don't know, HTech is our healthcare technology and innovation index, and we launched it in June of 2019. So it has been live and trading for on the New York Stock Exchange and the London Stock Exchange for over a year now. And so now we'll break into some of the characteristics and performance attributes. Go to the next slide. So as you can see, HTEC has continued to outperform global equities indexes in Q3, with HTech returning 13.8% in the quarter and outperforming ACWI, who returned 8.1% in the quarter. Also outperforming the S&P Global Healthcare Index of 4% during the quarter. So we are seeing some outperformance relative to global equities as well as global healthcare equities. And due to our additional focus in the healthcare innovation area, I think that performance speaks to some of the investor interest in healthcare innovation specifically. So as you can see in this graph, what you have here is the Global Healthcare Index, representing one of the largest known healthcare indices, and it's in the gray. And as you can see, it's more heavily weighed in areas such as pharmaceuticals, specifically large cap pharmaceuticals, as well as healthcare equipment and supplies, and services, things like that. If you look at the green, that is HTech. We do not have nearly as much exposure in the large cap pharma, the providers and services, also very limited exposure. But for us, we are more heavily weighed, if you look across at all the other green bars, in areas that we believe represent the highest level of opportunity for innovation and disruption over the next 5 to 10 years. So that's one of the things that makes our portfolio unique compared to what may currently already be in your existing portfolio. We'll go to the next slide. So here we are. If you want to know how we decide what to put into the index, it's comprised of a proprietary subsector classification. So what that means is we look at across a broad range of healthcare subsectors And we determined which ones we believe represent the most disruption and the largest level of upside over the next 5 to 10 years, as I mentioned. So areas such as medical instruments, diagnostics, precision medicine, robotics, and that's sort of what we highlighted earlier in the previous bar chart, that we tend to be more heavily weighted in these innovative areas. If you look at the chart on the right, we're showing the total returns, and this is how the index subsectors performed during the quarter. As you can see, genomics returned 30% during the quarter, interestingly led by a lot of innovation happening in that area. Almost every single company in our index under that subsector returned double digits. Data analytics was also a strong performer in the quarter. And then one of the underperformers during the quarter was precision medicine. But across our subsectors, all but one had positive returns during the quarter. And here we can see that we do have global exposure, which is another unique attribute to the H-Tech index. Over 79% of the index is in the US. However, over 20% are companies that are based outside of the US. And then in terms of portfolio characteristics, we've got, we use a modified equal weighting methodology. So that is another unique thing about this index. If you look at other healthcare indices, you might see that some of the top 10 holdings comprise a much larger percentage of the overall portfolio, whereas for ours, the top 10 holdings only comprise less than 20% of the portfolio, and the largest holding has less than 2%. So, so we do have a pretty diversified array of, it's a pretty limited amount of exposure for any one equity in the index. And then if you look at the overlap, when I mentioned earlier that there might be a lot of stocks in this index that aren't currently in your portfolio, if we look to the right, we can see the H-Tech's overlap with other indices, S&P and ACWI, less than 5% overlap, and then a comparable healthcare index, less than 20% overlap. So it is pretty uniquely positioned to capture exposure in areas that most investors don't already have. And then in terms of portfolio characteristics, when you go looking for those real innovative companies in those forward technological areas, what you wind up with as a result is an index that's more heavily weighed in small and mid-cap companies. As you can see, roughly half of the index is comprised of small and mid-cap companies, as illustrated by the chart on the left. And then our median market cap is about 11 billion. So once again, highlighting that we're not very heavily weighed mostly in large cap pharmaceuticals and health insurance companies. And then in terms of fundamentals, since a lot of these companies are in high growth mode, we do focus in the various earnings fundamentals. And we'll call out here that the median EV sales ratio of the index is less than 7 times. So still a high degree of upside there. And now we'll dig a little bit deeper into the actual companies in the index and some of the top and bottom performers. During Q3, NanoString was one of the top performers. And this is also representative of this broader genomic space where we're seeing a lot of excitement. There's a lot of innovation happening in terms of being able to do more with less, being able to buy instruments at a lower cost. And the global pandemic has definitely accelerated it's highlighted the need for additional research in terms of genomic studies to see what types of things we can do to help get ahead should there be another pandemic, and also to help stay ahead of how to manage this current pandemic situation. So, so NanoString is involved in a lot of areas like spatial imaging, and interestingly, during a time where a lot of hospitals and labs are slowing down large capital investments, they are still able to make investments in NanoString's products and technology because they do want to continue to advance their research. So, so NanoString had a good quarter. Livongo is a market leader in remote monitoring specifically for chronic illnesses. And this company had just announced that they're going to be merging with Teladoc Health during the quarter. This was one of the largest acquisitions in our space announced. It was over $16 billion. And so the exciting thing here is that Livongo has grown. They've more than doubled their members during the last couple of quarters because they focus specifically on remote care for chronic illness. And this patient population, people who have, for example, diabetes, are among the more vulnerable during the pandemic for higher risk situations with COVID-19. So the pandemic did cast a spotlight on remote monitoring, and Livongo, their uptick in sales and adoption was accelerated by this. But in general, in the long term, there is still a lot more to come with this company because they have expanded beyond diabetes into other areas of chronic care management, including mental health, which is a fast growing theme in healthcare, as well as weight management and other areas. So really exciting to hear about this acquisition, and I'm sure more to come in the years. And then we mentioned earlier, 3D Systems is one of the bottom performers, so I won't go into that again. And BioMarin also was one of the lower performers of the quarter. They received a letter from the FDA essentially asking for more data on a trial that they're having for hemophilia A therapy. So it's not that the trial is dead, it's just that they need more information. And this is gonna hold off FDA approval for maybe another year or so. So there was a dip in the stock due to that. And then just some other interesting things that happened during the quarter in H-Tech. We mentioned earlier all of the excitement happening in genomics, and we actually held a webinar and published a white paper last month on the fast-growing world of liquid biopsy and early cancer detection. So interestingly, in line with our thesis that cancer detection is going to be a huge area of growth in the next 5 to 10 years, Illumina has made a move into that space with the announcement of its intention to acquire Grail. This will be a $7 billion acquisition, and this will give Illumina the ability to enter this really exciting market, which probably brings about $70 billion worth of new addressable market for Illumina. And then Invitae similarly made an announcement during the quarter to acquire ArcherDX. And this is, again, Invitae's way of saying we want to get more involved in this early cancer detection as well. One of the things that ArcherDX brings to the table is that many people don't know this, but the vast majority of genetic testing that's done for cancer happens at the large academic medical centers. But 85% of the people who are being treated for cancer are being treated at the community level. And so when Invitae announced the intention to acquire Archer, this is going to help them democratize genetic cancer testing and bring it to the community level so that more people will have access to this type of testing. So as more companies invest in this, we could see more rapid adoption and, again, a huge, rapid growing addressable market. And with that, I will pass it over to Lisa.
Thank you, Nina. The Think Index is a strategy that captures the mega trend of artificial intelligence as companies small and large are seeing acceleration of growth from the AI deployments that's occurring around the world today. Think is now trading in the NYSE with ticker symbol THNQ as of May of this year. For the third quarter, Think Index posted a gain of 10.5%. It continues to outperform global indices such as MSCI World and also broader US market indices such as S&P 500. As you can see, year to date, the Think Index rose more than 35%, and in the last 12 months, it gained over 50%, outperforming the major equity indices. Even in backtesting to 5-year figures, Think continues to outperform. In terms of sector performance, many of the subsectors finished in positive territory, except for a small downtick in big data analytics. E-commerce subsector continued its strong momentum, returning almost 20% as the current health crisis has magnified the importance of having an online presence for businesses around the world so they can engage with its customers. Index members like Square, Shopify, and Yandex were strong performers this quarter, as they are providing solutions that connect merchants with its customers using advanced analytic and machine learning algorithms. These e-commerce index members are creating a different and highly customizable experience for each user. However, the biggest contributor during the quarter was the cognitive computing subsector, with Tesla and Nuance with outstanding performances. These companies are leading the way in developing deep learning and neural networks for the respective industries they're targeting. Overall, what is driving this outperformance for Think Index is that the demand for cloud solutions combined with AI capabilities continues to gain tremendous momentum. Many of these index members were seeing strong growth rates pre-pandemic, but we're seeing that the acceleration of the cloud migration has definitely increased the spending around AI systems and capabilities this year. To go deeper into the third quarter performance, Tesla, a leading electric vehicle provider with semi-autonomous software platform, was a top performer during the quarter with shares rising over 98%. Tesla's global vehicle sales increased over 50% the past year, and the company surpassed 1 million mark of electric cars produced. The Model 3 car now ranks as the world's best-selling plug-in electric car, and basically, various reports indicate that Tesla accounts for over 80% of EVs sold in the US in the first half of this year alone. We believe Tesla's momentum appears to be accelerating as demand is still surpassing the available supply. In addition, another top performer, AMD, in our semiconductor subsector, led the group with shares up 56% during the quarter. AMD is uniquely positioned this year with a strong tailwind heading into the holiday season with an upcoming game console product cycle, as well as continued momentum in PCs and notebooks. Basically driven by trends and what we're seeing in virtual learning and remote work. AMD has really executed very well with its product roadmap, with its advanced processor chips. And we expect they will continue to take market share from Intel over the coming years. Meanwhile, we saw weaker performances out of big data analytics this quarter, reversing its trend from the past year. Big data analytics was up 63% the second quarter. So you can imagine the expectation was pretty high going into the earnings season in the second quarter. Overall, some of the index members, such as Alteryx and Splunk, saw key AI projects get pushed out a bit and was basically unable to close their deals by end of the quarter. Longer term, these members are well positioned in the data stack and the digital transformation we're currently witnessing, as enterprises will need to derive intelligent data to gather meaningful insights as the world migrates its business to cloud platforms. Most recently, Alteryx pre-announced positively in early October with shares basically gaining back most of its losses as some of the large AI deals are starting to return. Meanwhile, New Relic, a cloud-based infrastructure software provider, saw shares decline over 18% during the quarter. New Relic software helps IT departments track the performance of digital assets. It's an area that has become really crucial in the COVID-driven remote work landscape, currently where we're in right now, where traditional monitoring techniques are showing limitations. New Relic has launched an integrated platform called New Relic One, and is starting to gain a lot of interest lately among its customers. We are confident that they will regain their footing as deployment and data analytic projects recover. Think Index captures the broader AI ecosystem around the world, with almost a third of members being outside of the US. And I think it's also important to point out that it has a very low overlap with the MSCI World Index as well as the S&P 500 Index and various other competing indices. Our top holdings are truly unique, and it captures all of the companies that are enablers and users of AI with high revenue and investment purity around AI capabilities. Think has a diversified market cap exposure. It does have a bigger tilt to the larger market capitalization than the H-Tech or robo strategies, because in order to develop and build AI capabilities, you need quite a bit of resources to build your own AI team. Some of the index members in Think even design and develop their own processor chips. And many are also in the process of building an ecosystem of IT developers. We have almost 20% of companies with market cap under 5 billion in terms of composition, and many of them are underfollowed. So it's a pretty good diversified group of companies. Overall, the companies in our Think strategy are developing building blocks and leveraging machine learning capabilities as enterprises around the world are undergoing major digital transformation to go after massive revenue opportunities and also to drive cost savings within the organization. During the quarter, many of the index members spoke about increasing its tech spending, R&D costs, hiring more software engineers, and also using this opportunity to make strategic acquisitions. This is a bullish indicator that enterprises are starting to see visibility improving. And as we look out to fourth quarter and beyond, we anticipate that enterprises will continue to increase capital investments in their technology and accelerate in the areas of AI, productivity enhancements, and remote work infrastructure, which should continue to support the growth prospects of these index members. You can see that much of the sales growth over the last few years has been very strong for the companies in the Think strategy. Thank you, and back to you, Jeremy.
Thank you, Lisa. Thank you, Nina. And now we will take your questions. So please feel free to type them into the Q&A box at the bottom of your screen. We have a few coming through already. And I think we'll start with, we have a number of questions around the difference between the ROBO strategy and the Think strategy, as well as the overlap of the index with each other. So let me start, and then I'll pass it on to you, Lisa, to explain more of the difference between Think and Robo. But essentially, our three indices overlap in certain areas. You could see Robo as the core, where we cover the entire value chain of automation. But Think has a clear focus on one of the key enabling technologies of automation, which is AI and machine learning. So here we have overlap between the two of just about 10%. And similarly, H-Tech is really expanding the healthcare automation opportunity into that broader set of disruptive technologies for the healthcare industry. So any innovative technology that can change the game in the healthcare industry would be covered by H-Tech. So all of the Robo members that play on the healthcare automation are included in H-Tech. And the overlap there is also around 10%. Lisa, do you want to expand more in terms of the differences between Robo and Think?
Yes, I think for Think, we really capture the entire AI ecosystem. So we look for companies with purity in AI revenues, as well as investments around AI capabilities. So we're looking for companies that are enablers and developers of AI, as well as companies that are using AI to go after big revenue opportunities. While I would say the Robo strategy, AI is an important component of the methodology, but it's not a pure play AI strategy fund.
Okay, thanks. Let's move on. We have a question about the COVID-19 impact on the H-Tech portfolio. Nina, would you like to take that?
Sure. There were, interestingly, because we focus on innovation, there were a lot of companies that we selected before the pandemic to be members and included in the index, largely due to our primary criteria, which is that the company needs to be a market leader, it needs to be a technology leader. So as a result, the portfolio itself was very well positioned to capture, I guess, the value of the companies that were very rapidly innovating to respond to the pandemic. For example, in the diagnostics subsector, we have a large representation, at least 10 different companies who were among the first to develop a test for COVID. And there were a huge range of different tests. There's rapid tests, there's antigen tests, there's PCR-based tests. And due to our diversity, it wasn't like we had one company in the index and said, wow, we were lucky we had the good one. We had a group of leaders and they were able to all be positioned to respond very quickly with scale and efficiency based on their past experience to quickly come up with a test. Interestingly, another area would be in the precision medicine subsector. We have some innovative therapeutic companies. Moderna is one of them. Moderna, due to the last decade worth of research and development in the mRNA therapeutic space, they have been working on various vaccines, for example, for CMV, for RSV, respiratory illness for children. They've been working on Zika vaccines, and all of the practice that they've gotten and all the data that they've accumulated thus far has made them more efficient and able to rapidly respond so quickly that when the first outbreak occurred in January, Moderna said, hey, let's see if we can use our technology and come up with a quick vaccine idea for this. And within a couple of days, they actually developed something that they could begin to use for clinical trials. So Moderna was in our portfolio from Q2 onward. Regeneron, another therapeutic leader that's doing a lot of great innovation. They were one of the first to develop something that could be effective for Ebola. And once again, using that knowledge and that scalability, they were able to replicate and rapidly advance something into the clinical trial for a COVID treatment. Interestingly, one of them was involved with one of their experimental drugs was involved recently to treat the president of the United States during his COVID illness. So, there have been a lot of companies that were already well positioned to be present and react and respond very quickly. And then one area I cannot gloss over is telehealth and remote monitoring. These technologies have been around for a long time, over 10 years, and they have been sort of slow to adopt. People were really just interested in seeing their doctor face to face, getting in their car and making that appointment. And then when all of a sudden the world said, don't get out of your house and don't go see the doctor, but people still needed to see the doctor, it exploded and accelerated adoption for telehealth, as well as remote monitoring. I mentioned earlier, people with diabetes, they need to continue to manage their illness, but if they're not getting out of the house and going to see the doctor, you need to be able to do that remotely. So pandemic also accelerated and cast a huge spotlight on the technology that exists, and let's use it more. And we're seeing legislation follow. We're seeing government funding follow to continue to adopt and embrace these new technologies. So we have this diverse exposure across HTech, and the pandemic does explain a lot of the outperformance this year, but it's just really addressing the tip of the iceberg of what's to come over the long term.
Thanks, Nina. We have a question around the index methodology and company selection process. How do we identify new companies to add to the strategy? So I think it really starts with research. We monitor somewhere between 350 and 400 companies that play across the themes that we discussed earlier. And how do we research these companies? Well, we do traditional fundamental analysis. We do technology analysis. We take the long-term view. We measure the revenue associated with each and every sectors of the classifications. So we look for companies that have a high revenue purity to our themes. But we also look for companies that are technology and market leaders. That means they have a track record of being on top of their market segment, of their industry in terms of innovating, coming up with new technologies and really dominating their space. Market leadership, is essentially having a high market share in what they do. So we score every company on a regular basis, on a continual basis. We score them on those metrics. We also exclude companies that fail our ESG policy. And we have certain ESG issues that relate to robotics, automation, and healthcare. And based on that score and how the score evolves, that determines eligibility to the index. So a company that sees a high score on those metrics will become eligible. And then we have a number of more quantitative factors that come into the equation in terms of certain minimum market cap, in terms of a minimum daily trading liquidity. That's a minimum of $1 million trading value per day. And then once that selection is done, we have that quarterly rebalancing mechanism whereby every quarter we'll reset the weightings in the portfolios based on that scoring system. So you have this embedded mechanism of selling the stocks that have done really well and buying those that have come back down. And companies will come out of the portfolios when their score drifts down, or when, say, there's a corporate action, they make an acquisition outside of our area of focus and their exposure becomes diluted. So those are our typical examples. Moving on, I think I'll send this question over to you, Lisa. Some components in the Think strategy have seen huge gains year to date. How are you rotating out of big gainers or cutting back, or do you still see room for these stocks to continue running up?
We see a lot of room for these stocks to continue posting gains, because we do take a very long-term view. We think what we're seeing in the AI adoption is still in the early stages. We don't really trim back based on valuations at this point. We're looking at scoring as a reason why you would see a stock, one of the index members, getting rotated out during our rebalance. So purity in AI revenues, investments, market leadership, tech leadership, those are sort of the important metrics that we will look at. Those are the factors. Whether a certain stock has gone up, 50%, it really has to be about the company's positioning and strategy, whether it's changed. If we see that a company is completely rotating out of artificial intelligence, building the capabilities, it would probably score lower, and they would probably be removed from that index, from the index. So those are probably the kind of the main factors, what's going to drive when you see some of the rebalance things happening.
Thanks, Lisa. I see another related question around how often Robo, H-Tech, and Think are rebalanced. We rebalance quarterly. We reconstitute quarterly. That means we have new entrants and exclusions every quarter, although that tends to be really at the margin. Typically, you will see 1 or 2 companies coming in and out of each portfolio every quarter. But we also rebalance every quarter, meaning we reset the weights. And so with regards to the previous question on Think and are we selling our winners, well, we have this mechanism embedded in the index methodology. That means that stocks that have really outperformed, we tend to trim every quarter. There's a question around which subsector is more promising in the near term. And I think that's a really interesting question. And that's a very hard question because, you know, it's very difficult to make predictions, especially when it comes to the future. And I think that's why we have this approach whereby we don't make any concentrated bet on any specific sector. We have a diversified approach. We want to capture all relevant sectors because we don't know where the next big hit is going to happen. However, when I step back and I look at the overall mega trend of automation, we've seen, I think over the past 20 years, you know, great success around the automation of manufacturing. And then the sweet spot kind of migrated over the past 5-7 years towards logistics automation and the boom in e-commerce and warehouse automation and the likes. We think that the next big economic sector to be profoundly transformed by these technologies is healthcare. And we're in the very, very early stages. So I can't give you a good answer in terms of the best subsector near term, but we think that over the medium to long term, healthcare looks very, very promising. And I see a few more questions, but I think in the interest of time, we'll take them offline. We'll get back to you. If you have any other questions, feel free to send them over. You can reach out directly to us via our website, roboglobal.com. That's also where you'll find a good number of our research that we make publicly available through the roboglobal.com website. I want to thank everyone for joining us today, and we very much look forward to speaking to you again soon. Thank you and have a good day.
Thanks, everybody.
Thank you.